You have to buy when everyone is fearful. I've been making videos about the market bottoming, and people think I'm nuts for having this much invested, including my margin, which is about 300,000 right now. People think, that I'm crazy, but in a down market, you're supposed to buy. You're not supposed to buy when everything's high. You're supposed to buy when everything's low. And people can make the case that we're going much lower, but we're already down 20% from the highs. NASDAQ reached 30% down from its highs. So how much lower can we go? And some people are saying, yeah, about 10% down from here. Well, if we only go down 10%, then why not just go ahead and buy now? I mean, long term, in 10 or 20 years, you're going to be right. The market average is 7% returns over time. So, of course, you're going to be right if you buy 20% off the highs. So we've taken all of our funds. And by the way, you see here, we're up 8% for the year. Market's up 3.5%. NASDAQ is up 11%. As you can see, we took all of our positions in the portfolio and we rated them and changed the weighting and the allocation I have in them. So we cut the inferior funds to 5K over here, 5K for the inferior funds. And that's 30K we can dump in case there's a big pullback in the market, and we would drop our margin to 260. Plus, I'm in talks to get a loan right now for 30K, which would dump my margin to 230. And I get the loan because I get dividends. As you saw, as I started out the video, we make about 100,000. So that qualifies for loans, and so that pays my margin off in advance. So I have these $5,000 names, plus we have our shorts, which are, we have 4,000 in tech short, triple short, and 6,000 in the S&P triple short. So that's times 3. That's like having 30,000 of a single short against the portfolio. So that's a good amount of short exposure there. Plus we have some short cornerstone here of about 8,000. So in real terms, that's about 40,000 in shorts. So we have our shorts in, plus we have short options. I had one guy tell me that, and actually many people tell me that that's the best thing I'm doing is short options, and that's where I need to be, short options. But again, everyone's calling for that. Plus I have sector-specific shorts. So we bought the banks last week. When Silicon Valley Bank collapsed, we ended up taking a nibble on some banks, and we have 1,000 in FAS now, but the triple long bank. But we also have 500 short. So if I'm wrong, I break even. If I'm right, I make more money on the long side. So this is how we play all of our sector-specific triple longs. We hedge them with shorts. So I'm not worried about those. I'm only worried about collecting the income. And what's funny is people think they can predict this black swan, but a black swan by definition is a surprise and it's not predictable. So it's sort of an oxymoron when you say that you're surprised by what you predicted. You can't be surprised by what you predicted. So that would not be a black swan. So people are so fearful right now. Consumer sentiment levels are at 20-year lows. I also have some notes here if you want to check them out that I want you to consider if you don't mind. You can't predict a surprise. The VIX spiked to 30 and 40. So that's a good sign of at least maybe a short-term bottom. But when the VIX hits the $30 to $40 level, we've made videos on this. Usually it's the sign of a market bottom. When the VIX is high, time to buy. When the VIX is low, time to go. So when the VIX is high, this is when you step in and add to positions in your longs in the stock market. So the VIX here spiked to 30, as you can see. So touch 30, and when it touches 30 historically, that's a sign of a pretty good sign that you can buy in the market. So every one of these peaks was followed by a market bottom once again. These are just indicators for you to consider. These aren't set in stone. Also, the 200-day moving average, when the market gets above that, usually it's a bullish sign, and we just got above the 200-day moving average. in the stock market. So the S&P, we could show you a chart of the S&P 500, and it's on the 200-day moving average, the orange line on a 5-year chart. That's really bullish. By the way, I wanted to show you one more interesting chart because I was looking at financials and trying to sell puts on some cheaper share price names like Bank of America at 27. But look at this; it's on its 10-year chart. It's on the 200-day moving average. So this looks like a good time to buy Bank of America. There's not one problem you can think of with Bank of America right now. No one can make a run on this bank. They have too many layers of security. So I showed you the S&P. I showed it to you on a long-term chart. Let me show it to you on a 1-year chart. The S&P 500 is around the 200-day moving average. We've been saying constantly that it broke out of the 200 and this was time to buy. And here we go. We see that it fell to about 400 a share, which is where the 200-day moving average is. So 400 a share. We're holding this area, this whole number area of 400 plus, we're at 395 plus this orange line is the 200-day moving average. So every time we're underneath it, it acts as resistance. We fall, but when we get above it, it acts as support. There you can see there. So here we're fluctuating and oscillating along this 200-day moving average. I think this is the reason for all the volatility, by the way, in the market. It's not just the banks and the SVB issue, because I think largely those problems are resolved. So people are just trying to figure out which direction the market's going as we're on this 200, and it's really affecting the algorithms and everyone's forecast. So also we had a lot of buying volume come in there, which is higher than average. So I thought that was bullish. RSI kind of oversold. It was almost at the gray, still around 40. It's a good time to buy. So, consumer sentiment levels being at 20-year lows, and everyone telling me I shouldn't be buying the market right now because it's so scary, is usually the cue for me to buy things. The way that we buy things, we don't care if the market moves up or down. It's a lot like real estate. We just care about collecting the dividends. Real estate, you care if the renter pays off the mortgage in 15 to 30 years. We just care that these dividends pay back our positions in 5 to 10 years. So Cornerstone, 20% dividend. As you can see here, we collect all these dividends. Cornerstone, we get a substantial amount from Cornerstone, and that's 20%. So that's 5 years, 20%, 100% payback, and it drips reinvest the dividends at the NAV. So we get 30% gains automatically on those drips. Look into those from past videos. IAP is a car icon, tax shelter. So is AMZA. These things are tax free. Look into those videos. All these things, all these positions pay back our cost basis. They pay back our investment in 5 to 10 years. So it's much quicker than real estate. We don't care if the prices of the market go up or down. We just want lower prices of the market to add to positions to get bigger dividends, because as the prices fall, the dividends grow, the yields grow. So I think I showed you the performance. We're beating the market with this strategy, even though we're leveraged and the market's fallen significantly recently, like bank stocks and things. Even on our ETFs that have some significant bank weightings, we're still up 8% because these dividends, they make up for a lot of our losses. We've lost over 100,000 in the past week. We're at 430, now we're at 330, but we're still up 8% for the year. How is that possible? Okay, because of dividends. So these right here are, the whole key, and they're high quality funds, 4 and 5 star funds, as I've told you in past videos. Here are those bond funds, GOF and RIV. We really made a point of adding to bond funds since if rates are falling and the economy is quote slowing, this is now a perfect time to re-enter bonds. So we only had 5,000 in these inferior names, like I told you. In the bonds, we had reduced to 5,000, but we quickly re-added to the bonds as the picture changed with interest rates. This past week with the Fed announcement, they said interest rates were going to be peaking, virtually. It was like a de facto rate cut that the banks are going to be giving us now, as they wind down lending. to keep their reserves because they don't want any runs on their banks. So they're keeping a reserve. So they're not going to lend right now. Some of them. Other banks will lend, okay? The competitive banks. And companies don't rely on banks the same as they used to. They can rely on free cash flows. I've said this constantly in other videos. So for all these reasons and more, I can't even find a reason to be bearish on the market unless something goes wrong with the banks. I am a little skittish about them, but if I trust the Fed, which generally you're not supposed to fight the Fed, that's the adage, don't fight the Fed. They said that SVB is safe, and they said that was an outlier. And I know that most banks are hedged with interest rate policies. So if they get hurt with interest rates in their bonds in one area, they're hedged in the other area. So and again, I think they'll keep making loans. I've heard some people on CNBC already say that they want to give loans at these lower levels. I'm just seeing a lot of positives, and I said that in the last video, but in this video, I want to say that, it just feels so wrong to share my video with other people and go talk about my channel and talk about the market. They're all so negative, and I can't understand how they think that they could be so right and so negative and time this so perfectly and be out of the market and be in cash. There's 5.1 trillion in cash right now, and how could they be so right? It's impossible to time the market successfully. They all think they're pros now. They can predict when recessions are coming, when the bottom is, when they're going to re-enter the stocks. I don't understand that. It's hard to time the market. I don't know why they think they can. So I'm just buying things regardless of them going up or down. We just collect the dividends, and when they go lower, you get higher dividends. So you keep buying at these lower levels as long as you don't get into a margin call. Which is my whole name of the game. So we're just keeping this number, trying to keep it safely above 100, so I never have to sweat a margin call. If that happens, again, all I have to do is sell my shorts, which raises about 15K equity, dump those 30K in inferior funds. As I told you, these 5K funds on the side here. I feel like, you should always, in a down market, cut your position sizes in half. Cut them in half, cut them in half. That way, when the market keeps falling, it takes the sting out of them, so you don't get hurt as bad when you cut them in half. And then when you eventually dump them completely, you don't take much in losses. And then you take those funds and you replenish them back and you redeploy them back in these higher quality funds. You barbell up into cornerstones of the world, and I went into these triple leveraged ETFs, which I've made videos about, UPRO and TQQ, because they give me the best bang for my buck. If you hold them for 10 years, you would have made $1 million if you saw that past video. So, if I sold 30K in stocks, I can buy back 10K in triples, UPRO, let's say, and that takes care of the 30K in stocks I just had. So, because 10 times 3 is 30. So if I buy back 10K UPRO, it's like having 30K single exposure. So when I sell these 30K at the bottom, these 5K, 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 and I take some losses, and I'll deploy half of that 30 into the C's because those dividends are 20%, and most of these 5K funds are 10%. You sell the 30, so you lose 10% on that 30. You lose 3K income, but then you buy 15K of these 20% yielders, so you keep the same amount of income, but you free up 15K in cash, and you went to higher quality, so it's a good thing. And then with the other 15K that you're missing, which you need to get back in performance from capital gains, you just buy 5K of the triples, like I do here, UPRO and TQQ. And now I have saved 10K in cash and 10K in equity, and I lower my margin. So when the market really falls, it's like an opportunity to get much stronger, to tell you the truth. Why wouldn't I just go all in these funds right here, right now? Because you don't buy these funds at the highs. You buy them at the lows, okay? You don't buy the UPROs at the highs. You buy the bonds at the highs. You sell them at the lows, some of them, and you go into the higher beta, bigger bounce back cyclical names like UPRO and TQQ. They don't pay a big dividend though, so I don't put most of my money in them. I put most of the money in these other funds. That pays us the $100,000 a year. Anyway, that's my strategy. You know my strategy. You've seen them from past videos, but I just wanted to tell you that about negativity. You cannot predict a black swan by virtue of that. It's an oxymoron, okay? If everyone's negative, you go opposite. Buy when everyone's scared. And with income, it doesn't matter if you lose because the dividend pays it back over time anyway, and quicker than real estate at that. So hope you enjoyed the video. Subscribe if you liked it. Comment if you have any ideas on what we should all be doing better in this environment. Thank you very much.